Hello, fellow Rebel Capitalists. Hope you're well. And of course, I forgot to check the mic prior to hitting the. Yes.
It's all good.
Okay. Now we should have the correct mic on. Josh, how does that sound? That sound better?
Yeah, much better.
Okay, cool. All right, guys, let's dive into the news for the day. I just got done doing a whiteboard video, went over to the CNBC homepage, and I tell you what, the economic indicators are going from warning of a recession to me, it looks like they're warning of a economic depression. I mean, this is getting completely crazy. So let's go over to the CNBC homepage. Actually, let's go over to the spread on the 2s and 10s first. So this is now at 10 basis points. So you guys have heard me talk about the inversion of the yield curve quite a bit on this channel and in my whiteboard videos. And just the other day, last week, it inverted again, but it was maybe 2 or 3 basis points. Now that inversion has grown to, let's just call it 10 basis points, roughly. And this means that the 2-year interest rate is 10 basis points approximately higher than the 10-year. And it has been inverted now for, I think, a week, maybe even longer than a week. Now let's go over to the dollar. The dollar hit a 52-week high today. It was over 108. It's at 107.92 right now. But earlier in the morning, actually, I can go down here and tell you exactly. The high of the day, 108.56 on the dollar. So this is another indicator that's telling us that the global economy is grinding lower and lower and lower. Economic output is decreasing. Therefore, it's not just recession concerns in the United States, not even close. This is telling us there's recession concerns globally, and that will most likely trickle into the United States. But I think the United States is headed in that direction on its own. Now let's move over to the CNBC homepage. And they talk about this. Actually, this is a specific story. Sorry about that. They talk about the bond yields, meaning the inversion of the yield curve, what we were talking about before. They say the bond yields fall with the part of the yield curve on pace for flattest close since when? 2007. This is why I titled the video, The Economic Indicators Have Gone from Recession to Economic Depression. So let's go through this story here, and then I promise you we'll get to the CNBC homepage. All right, U.S. Treasuries ticked downward on Tuesday as the closely watched 2s, 10s curve remained inverted and was on pace for its flattest close, or maybe steepest inversion close, I think is maybe what they're trying to say, since 2007. The 2-year dropped more than 8 basis points to trade. Now, I think this is a little old because now it's at 10 basis points higher, but remained above the, I see what they're saying. So the 2-year dropped more than 8 basis points to trade at 2.98. Oh, and by the way, yeah, this is old because now the 2-year is up over 3%, while the 10-year is maybe 2.3 or 2.93, something like that. Anyway, but remained above the 10-year Treasury, which dropped 9 basis points to 2.9. The yield on the 30-year traded 8 basis points lower at 3.09. Wow, we're close to an inversion on the 2s and the 30s. I mean, the 1 year, for heaven's sakes, is over 3%. So we're, call it 9 basis points away from the 1-year Treasury trading higher, meaning the yield is higher on a 1-year Treasury than it is on a 30-year. I mean, let that sink in for a moment. We're not there yet, but shoot, we're, call it 9 basis points away. Unbelievable. So here's the Treasury curve as of the time they did this story earlier in the morning. 3-month trading at 2.2, 1 year 3%, 2 year 3%, 5 year 2.99. So we've got an inversion there as well. And the 10 year at 2.9 and the 30 year at 3.11. Wow, man, it's almost like the whole entire curve from 1 year to 30 year is pretty much a flat line, other than a couple dips for some inversions. Jeez. Wow. This is just tough to get your head around. And then they go on to talk about the jobs report and Biden going over to the Middle East just to beg for oil. All right. Now let's shoot over to the CNBC homepage, and Dow up 116. So you might be asking yourself, why is the Dow up? Honestly, I think because the Dow is now starting to price in rate cuts, and it's almost like the Dow or the stock market has gone back to this bad news is good news, because the more bad news we get, the more likely it is the Fed is going to lower interest rates or do quantitative easing, which the market sees as bullish. I think maybe that's what you're seeing right now. I mean, I know the jobs data was supposedly good, but I think the market's smart enough to know that's a lagging indicator, and they're looking around at all the other things that we've been talking about and saying, whoa, time out here. Fed most likely lowering rates after maybe a couple more rate hikes, more QE, reverse course on QT, et cetera, et cetera. Basically, the Fed goes from being very hawkish to maybe we'll call it dovish, and just maybe the market is pricing that in, because we look at the 10-year down at 2.93. We look at oil, $96 today. Oil just, crashing. That's the only word for it. Down 7.75%, down $8 on the day. Wow. Gold down 3.5 or $3.50. Where's the NASDAQ? That's probably going to tell us where Bitcoin is. So Bitcoin, I'm guessing, is up because the NASDAQ is Bitcoin down. Okay, well, actually, as a Bitcoin bull, I think that's good news, because Bitcoin, at least today, who knows, we'll have to see what happens, but at least today, it's trading more like gold and less like the NASDAQ. So I think that's something to be optimistic about if you are a Bitcoin bull. But the main takeaway here, guys, is wow. The numbers and the data is just looking horrific. So there are no certainties. There are only probabilities. But my goodness, the probability is just going higher and higher and higher that we will not only see an economic recession, but potentially an economic depression. So then what happens with the Fed? What happens with interest rates? What happens with QE? What happens with stimmy checks? What happens with deficit spending? This is what I've been talking about for a long time. And Lynn Alden, my partner in Rebel Capital's Pro, has also been talking about this. When we first started seeing inflation, we were talking about how it's really about government spending, deficit spending, and stimmy checks, and how are you getting dollars on the balance sheets of non-bank entities, average Joe and Jane. So when the stimmies work great and they give that, we'll call it a sugar rush, that's the word that most people have been using, gives that sugar rush to the economy. But then once that sugar rush wears off, there's no more purchasing power. At the end of the day, the amount of jobs and the amount of people we have working in the United States right now is less than it was in 2019. No matter how many job starts or whatever the jobs data is telling us now, that's really the bottom line, is we have fewer people working today than we did in 2019. And think about that. The population hasn't decreased. The population has increased, but yet we have fewer people working. So you would assume purchasing power goes down, aggregate demand goes down, and I get it. We have supply chain issues, but this means prices go down in aggregate total. Now, I did a whiteboard video today on the bullwhip effect that Michael Burry has been referencing. We did a live stream on that yesterday. Excuse me. And in this whiteboard video on the bullwhip effect, we talked about inventories just skyrocketing for these retailers and how this works its way through the entire supply chain and how this could compress corporate earnings. And this could create an earnings recession on top of the economic recession that the yield curves are predicting right now. Maybe that's what the yield curve is trying to tell us. Maybe it's saying, hey, the recession that you're going into or that you might go into is going to be the catalyst may be an earnings recession from corporate America. Who knows? But this bullwhip effect could have a significant impact on the downside for the U.S. economy, which brings us to recession, which again brings us to what does the government do? And my original point there was, even when we had the inflation, I said it's all going to be a matter of government spending. You have to start answering economic questions by first answering political questions. Is the government going to come out and do a CARES Act 2.0? What's the Fed going to do? Are they, how much QE are they going to do? How is that going to affect the balance sheet of the average Joe and Jane? How much more funny money? And then to take it one step further, to answer that question, I think you have to say, well, what's the CPI? When we go into a recession, if we go into a recession, is the CPI at 8 or is the CPI at 3? Or is it just trending lower? I think it's safe to assume the highest probable outcome, if CPI is at 8 or 9, is that the Fed either doesn't do anything or they continue to raise rates. I think the highest probable outcome, if the CPI is 3%, is that the Fed comes in and we get a repeat of the cerveza sickness, meaning CARES Act 2.0, quantitative, QE infinity. Who knows what they'll do per month, backstopping all the corporate debt market and yada, yada, yada. I think the question becomes, what do they do if we're just trending lower? Meaning that we go from, let's say, 8.5 or 9% down to 7.5, down to 6.5, something like that. Then what do they do? If we're in an economic recession or depression, who knows? Are they going, just because inflation is trending lower, are they going to say, okay, well, and maybe even more importantly, what will the general public do? Just because inflation is trending lower, but yet still very, very high, is it going to be politically palatable to have the Fed come in or the government come in and do what they did in March of 2020? I don't know. I'm just throwing that out there because I think that's probably the highest. I think that, let me think this through. Yeah, I think that would be my base case. I think the odds are highest that we see a situation where we're in recession and the CPI is trending lower, but we still have a very high levels of inflation, relatively speaking. So again, say it's 6.5, something like that. Maybe even 5% historically is still in the no bueno zone, if you will. So that's what I would suggest trying to think through currently. Like what does that world look like? What does the Fed do? What does the government do if we go into recession and we haven't gotten the CPI down to a level that would be politically palatable? All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. See you in the next video.